Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, August 25th, 5:05 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Not a lot of changes this week, a couple of drop offs, a couple of ads. Doesn't really need a bunch of review over the weekend. If I do add or delete a couple over the weekend, I'll update it on Friday or so on Monday, but I expect it to stay as is. State of the market, we are in a mild correction between 4 and 5% off of the uh, index highs from earlier this month. Check the trend gauge over here. We've got a red arrow showing on market leadership. I know the red arrow says bearish downtrend. I mean, leaders aren't in a downtrend. They're weak. They're avoids. If they're in a downtrend, they're not leaders anymore. The best of the best are consolidating, and I have no problem still getting 21 stocks to be on the leaders list. So the red arrow really means avoid. On the other hand, as far as the indexes are concerned, we are in a downtrend relative to the short-term 21-day moving average, and we're below the 50-day moving average. So the arrows are red there. Long-term, still fine above the 200-day moving average. Remember, the market never gets into serious trouble. Serious trouble meaning a bear market. Bear markets don't occur above the 200-day moving average. In fact, on average, from high until the break of the 200-day moving average is closer to 11 to 12% historically. So we're only halfway there as far as how far we're off of the highs on the S&P 500 anyway. So what happened today? All eyes were on Fed Chairman Jerome Powell as he gave a speech a little after 10 a.m. this morning from the annual Jackson Hole Symposium. And as usual, after he gets involved with speaking, the market showed quite a bit of volatility, initially down, then up, then really down, then really up, then sold off again, then bounced. Typical indecision after Powell, but the bottom line after all that volatility is the indexes closed higher. Leading stocks acted okay, and indexes continue their basing, which is basically what it's been doing for about 2 weeks now. Here are the final numbers. Our 8 growth ETF composite, the RG8, up 0.72%. S&P 500 up 0.7, Nasdaq 100 up 0.8, Dow up 0.7, mid caps up 0.33%, Russell 2000 small caps up 0.4%, Global 60/40 up 0.34%. Bonds mixed on the day, but the broad bond index a minor pullback. And in-house GROTECTION up 0.23%. We benefited from our big exposure to the S&P 500. That's the way we play things when the markets are indecisive. And then we sprinkle in some tactical trades, hold on to leaders. We're still holding on to some NVIDIA even after selling some yesterday. NVIDIA down again today, but holding its 21-day moving average. So the breakout's a failure. But the gap up breakout after their earnings report is a failure, but the stock looks fine relative to its moving averages and considering the state of the market that we're in. We'll hit the tail of the tape in the 21-21 charts. Let's get into the indexes, and we'll start here with the S&P 500. So looking at the daily chart, you can see we stopped going down last Friday. That was day 1 of a rally. Today is day 6 of a rally. On day 5 of a rally, we had some high hopes with the initial gap up yesterday on the NVIDIA earnings report, but we were rejected at the declining 21-day and the flat 50-day moving average. Normal spot to bounce, as I've been talking about the big levels of support right below last Friday's low. Normal spot to be rejected at the moving averages that were formerly support and now have turned into resistance. Today, weakness, strength, weakness, strength. We ended up strong by the end of the day. Let's take a look at a 5-minute chart so you can see. Very obvious when Powell started speaking, first down, then up, then really down, then started to work its way higher, a little bit of a base in here. Tried to sell off again and it didn't, and then rallied higher, a little bit of a fade into the close. Let's go to a 30-minute chart, and it's the levels are more obvious in here. You can see the 4450 level, where we broke down on the 15th and rallied back up right above the 4450 level and failed. Uh, so really what we're doing is playing ping pong around this 4400 area, above and below it. We've got about 58 points above it. We got 65 points below it. So we'll see which way we resolve out of this range, which is about a 2.5% range going into next week. So basically a 2-week, 2.5% consolidation here. Obviously, the bulls are calling for a break below. The bulls are calling for a break above this 4450-ish level to get us back into finishing up the right side of this base and back into this prior consolidation before we broke down from 4450. Back to the daily chart here. One last look, and let's go to the NASDAQ 100 now. Very similar look. Last Friday, put in the lows, uh, support underneath it, normal spot to stop going down, rally up, failed at the declining 21 in the flat 50-day. Harsh rejection off of there yesterday. Felt like the world was going to end, but today, again, more volatility, finished higher. And the ping pong level is 365. As you can see here, we broke down 365 on the 15th, 16th, got down to 355, got up to 365, played around it a little bit on the 22nd, back above it on the 23rd, gap up on the 24th, failed, tested it early this morning, closed there by the end of the day. So the ping pong level on the NASDAQ 100 is 365. On the downside, 355. On the upside, 372, which was the high of the gap up, Thursday morning gap up. Onto the Dow Jones Industrial Average. Relative weakness early in the week, relative strength over the last 2 days, as that's kind of typical when tech stocks take a hit. The Dow will outperform on a relative basis, but you see we do have a stochastic hook up there. In fact, hooking back up on all 5 of the major indexes after a dip down yesterday, still in oversold territory. 34,000 providing support on the S&P 500, 34.6, which was the breakout level, now acting as resistance on the upside, as that's where we opened on the gap Thursday morning. Let's flip to mid caps now. Tighter range, not as much volatility, holding the 200-day moving average below the 21 and the 50, and small caps undercut but reclaim the 200-day today, just the same way they did last Friday. So that's a plus sign that they're at least holding that level, but pretty serious relative weakness the last 3 weeks in small caps, coinciding with the rise in interest rates. We've talked about this before, especially with small growth stocks needing, they just don't work in a rising interest rate environment, as they typically have debt to fund their growth, and the higher interest rates go, the more debt service they have to sustain. And Mike talked about some balance sheet return on equity in specifically on this weekend's podcast. Make sure you check that out. So those are the 5 major indexes. Let's flip to the VIX. The VIX was red basically all day. Let's take a look at a 5-minute chart on this. One spike with Powell, but down on the day, opened down as the indexes opened higher. And even when they were suffering, we just barely got to even on the day on the VIX, and then it sold off into the close to close very near the low of the day. So surprising down 8.8% move on the VIX today, back below the 21-day moving average. So this declining 200-day moving average also acting as a bumper on the upside. On the downside, we've got the 50-day moving average, and we're right around the 21. So we'll see what next week brings as far as the VIX goes. Let's flip to the dollar. Dollar making higher highs, not good for markets, but they didn't stop the market today. So 2 days up on the dollar, 1 day down, 1 day up on the indexes. How did that impact the precious metals? Gold closed near the highs of the day, just barely down. Tight closes over the last 3 days, as it looks like it's trying to put in a bottom. GDX down 1%, uh, bouncing off of the lows from last Friday, along with the indexes. Not as bad of a breakdown there, but it did run into the declining 21-day moving average and fail there. Silver had that big gap up earlier this week on Wednesday, and it's holding the gap up, so that looks the best of the three. On to bonds, the broad bond index BND. Uh, Bonds were volatile today, typical with Powell. You can see spike up, spike up, and then basing into the close. Bottom line is not much change at all on the broad bond index. In fact, it was flat. So we've got the bounce on bond indexes. Let's go to the TNX, and you can see uh, pullback off of the highs, holding above the 21-day moving average, looking like a support level here around this 42-ish area for the 10-year. Let's go to TLT, the long bond. Uh, ran up into the declining 21, so you'll see basically the reverse on TYX, supported at the uptrending 21. So pull back on rates. Are they going to base here? Are they going to challenge new highs? Or are they going to break down? That will probably have a lot to say with what the market ends up doing. So that we'll check Bitcoin just because people ask about it. Bitcoin in a tight 6-day range after a breakdown last Friday. So that's our inter-asset correlation. Let's go to the tail of the tape now. Oversold on the stochastics, but again, a hookup trying to get off of oversold on all 5 indexes and on the RG8. The NASI RSI still in oversold territory and trending sideways to lower. Dollar higher highs, pulling back on interest rates. One good thing, sentiment for the third straight week has fallen now. As the old saying goes, there's nothing like price to change sentiment. So the bullish percentage is now below the long-term average. The bearish percentage is above the long-term average. So this is in the direction that the market wants it to head. As far as putting a bottom in, you don't want to see euphoria. You want to see this continuing lower, putting in a bottom before the markets can bottom. Operating under the bear case, since we're below the 21-day moving average. Bottom line from Powell's speech today, the takeaway was we're going to be data dependent, but it looks like higher for longer on interest rates. Day 5, O'Neill rally day 6 was yesterday. O'Neill rally day 6 was today, and we ended green. We're right on the ADMA. On the S&P 500, 14 days below the 21-day moving average on the S&P 500. Expectations continue negative until we get back above that level. 11 out of 11 indexes finished positive today, led by tech and consumer discretionary and software stocks. On the downside, home builders, banks, and gold stocks. Portfolio change, we got stopped out on Uber. Actually, we didn't get stopped, we sold it with it closing the week below the 21 for a small loss, and we did add some to T-bills today. Adjusted volatility adjusted beta at a 0.73, with this being below the 50-day moving average. Our target ceiling is a 1.0 on this. The target floor is a 0.6. Bottom line on the day, Powell Jackson Hole volatility resolved higher by the end of the day. Index basing continues. That's our summary for this week. And those ping pong levels and the highs of Thursday and the lows from last Friday are the reference points on the indexes. So let's get to the 21 over 21 list now. And first, we'll talk about what got punted off. A stock got put on and punted off during the week, and that was what we got stopped out on. Uber. We have been watching it while it was basing along the 50-day moving average. Tried to move out on Wednesday, reversed yesterday, broke below. It was weak all day relative to other leading stocks and the indexes, and closed below the 50 and the 21. Sold it for about a 3% loss on a 3% position. Also leaving the 2121 is LNG. This chart looks fine, but two closes below the 21 and a weekly close below will get you put off the 21 over 21 list. We're still watching it. Energy stocks are some of the better setups in the market, and LNG has a great fundamental story, as Michael can tell you about. And Applied Materials, this closed right on the 21, but we need to see some more strength and more upside possibility here. Look at the relative strength line on this. There's times in here when it trends higher, but all in all, it's really not a two times the S&P 500 type of stock, and it certainly doesn't have the growth numbers uh, with them being flat, uh, to expect that this is going to massively outperform. So we took it off and replaced it with something that we think is better. And the two that we added to replace LNG and AMAT, first one is Fastly. Uh, the rare ascending base and breaking out of it today with relative strength at a new high. So this is follow through strength after reporting earnings a couple of weeks ago. Not a whole lot of tech stocks making new highs after reporting earnings. This certainly is one of them. And the second ad is Splunk, double bottom base. So really base on base, you can see the cup and handle that led into the double bottom and breaking out of it on earnings today and sustaining that strength today. So we'll be keeping an eye on this also. So Fastly and Splunk, the two new ones. The rest of these are carryovers from what we added last week and Monday. First one is CCJ, uranium miner, bounced off that 35 breakout level. LNW, Light and Wonder in the casino business, making new recent highs. Interactive Brokers continues to base after its breakout of a flat base. Palo Alto, this one I went back and forth on. Big gap up after a sell-off leading into its earnings report. It didn't hold the bottom of the base, but it did hold the 21 today. CIBR is one of the better looking ETF charts, and there are three other stocks I considered putting on here. So, CrowdStrike, RPD, and QLYS. I ultimately decided on PANW to see how it resolves after this market gap up, or after this gap up on earnings, but may rethink that over the weekend and put one of those other three on. We'll see next week. ANET, negative reversal after the earnings report by NVIDIA, still consolidating after its earnings gap higher. There's NVIDIA. Reversal off that 500 level. It's at 460, so basically not really far off of that. $40 off of 500. Not a whole lot to complain about there. It's just pulling back, and the market probably having something to do with that. CEIX, great coal stock, consolidating this week. AAOI, two very volatile down days, but on below average volume. We got some insider buying here too. This is a very high ATR stock, but it's a leader if the market is righting itself. Lilly, tight to higher consistently over the last 3 weeks. NVO, tight, not higher, but tight over the last 3 weeks. APP, looking great, challenging that 40 level. The market is holding it back. Celsius continues to work higher after its earnings gap up. Axon bounced at the 50, 200, and 21-day moving average today after its earnings gap up, still inside the base. DRV, this is inverse. Real estate bounced off of the 21. NRGU undercut but closed right on the 21. Energy stocks, like I said, some pretty good setups here, and this thing just looks like it's flagging after forming a high handle after this cup base where it broke out above that 469 pivot. Bunge pulling back, low volume, bounced at the 21. VRT, probably the best looking and strongest stock, tech stock, sorry, data center stock in the market, completely shook off the negative reversal yesterday on NVIDIA to be up 7% today, at the top of the list for an entry. TBT, this is interest rates bouncing off the 21. This goes higher as interest rates go higher, long-term interest rates go higher. Weatherford holding the 21 on a pullback. And that's it. That's your 21 over 21 leaders list. Palo Alto, really the only questionable one in there. We'll see. I'll revisit that this weekend and see if we can come up with a replacement, and we'll update you on Monday. And with that, we are going to wrap up this week's video. Remember, it's not how much you make in the markets, it's how much of that you can keep. We've lightened up during this most recent pullback. Most everything that we've sold has continued to gone lower as leading stocks. Had a bunch of turnover on the 21 leaders list as sectors have rotated. Some high beta stocks just fell by the wayside, but but some others came up to take their place in different industries, and those are the ones that we're keeping an eye on. And with that, I'm going to wrap up the video for the week ending Friday, August 25th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening, and have a great weekend.